The Joint Legislative Audit Review Commission will please come to order. The staff has made note of members in attendance and advised me that we do have a quorum. We'll get underway. I will remind the members, and let me just say to all who are here, nice to see you again. I will tell you, with a choice between 5 minutes to turn on my Zoom and 2 hours to drive here on a hot day, it's kind of a toss-up, but you're lovely people. You're lovely people, all of you. So we have a rather busy docket, but I want to advise you also what else is different from the fact that we're here together is that we're live streamed. And members, I would advise you, we're live streamed. So we'll all stay alert and look forward to the docket as it unfolds. Mr. Gear.
Good morning, Mr. Chair, Madam Vice Chair, and members of the Commission. I'm Hal Greer, the Staff Director of JLARC. It's great to be back in person with you today. As you may recall, we generally devote the July meeting to VRS and Virginia 529, two agencies for which we have ongoing oversight responsibility. This morning, we will briefly present the JLARC staff semi-annual VRS oversight report. Then the VRS leadership will provide their annual status update. Next, you'll hear from the General Assembly's actuary, who will present the key findings from their quadrennial audit of the Virginia 529 prepaid program. And then Virginia 529 leadership will present their annual status update. And then finally, staff are going to provide you with a brief update on JLARC's ongoing review of the Virginia Employment Commission. With that, I'd like to turn it over to Kimberly Sartay, who oversees and supervises all of JLARC's ongoing oversight work. Kimberly?
Good morning, Mr. Chairman. For the slides to come up here a minute. So good morning. As Hal mentioned, I will be presenting our semi-annual oversight report of VRS. Just a reminder that this report is required by the VRS Oversight Act, in addition to several other required activities. Today, I will be covering VRS trust fund investments, the defined contribution plans, and a couple of benefits-related items. A core responsibility of VRS is managing the investment of assets in the VRS trust fund. This is important because the assets used to pay VRS benefits are pooled in the trust fund, and these benefits include retirement benefits for state employees, teachers, and local government employees, as well as other benefits such as life insurance and sickness and disability benefits. In total, VRS serves over 770,000 members, retirees, and beneficiaries. The most recent data available at the time we prepared this report is through March, and as of March, the trust fund had achieved a whopping 28.3% return for the one-year period. This, of course, reflects the decrease of assets at this time last year due to the pandemic and the decline in the equity markets and then the subsequent rebound. As of March, the fund held $96.4 billion in assets. Perhaps most importantly, total fund returns for all periods were above the long-term return assumption of 6.75%. This is important because if returns are below the assumption, funds need to be made up elsewhere, such as through increased employer contributions. This table shows you the fund's overall performance compared to its benchmarks. As you can see, the fund has met or outperformed its benchmarks for all periods. And again, the total fund returns are all above VRS's long-term return assumption of 6.75%. The trust fund is a diversified portfolio with investments allocated across 7 different asset classes, and they are ordered here from largest to smallest. Most asset classes met or exceeded their benchmarks for all periods, but you may notice that public equity failed to meet its benchmarks for the 1, 3, and 5-year periods. You may recall that public equity has been underperforming over the past year or so, but VRS believes that the market rotation that they have anticipated towards small cap and value strategies has started to occur, and they expect to see improved performance in the future. But we, of course, will keep our eye on this asset class moving forward. And Mr. Chairman, I can pause here briefly for any questions.
Members, do you have questions at this point? Hearing none, we'll go ahead.
Okay. Now I'll briefly turn to VRS's defined contribution plans. VRS manages defined contribution plans for state and local employees. Assets in these plans are completely separate from the VRS trust fund. Defined contribution plans are similar to private 401k and personal IRAs, where each participant owns a personal account and is responsible for choosing his or her own investments. Some plans are intended to be a primary source of retirement income, like the hybrid plan and the higher education plan, and others are intended to be supplemental income. In total, the defined contribution plans held $7 billion in assets as of March 2021, and there were over 250,000 account holders. One way to evaluate the investment performance of defined contribution plans is to look at the performance of the various options that people can choose. As shown here, the returns for the majority of defined contribution options exceeded their benchmarks, and for many of these periods, all of the options exceeded their benchmarks. I'll now move on to the last section of the presentation related to benefits administration. One of the most significant actions in this area is that the board recently approved changes to several of the actuarial assumptions for the VRS plans to improve their accuracy. The most significant change was to the mortality assumption, and the change will result in assuming that future beneficiaries will live longer. These changes were based on a recent experience study conducted by VRS's plan actuary. And I also want to point out that the changes implemented recommendation from JLARC's 2018 actuarial audit of VRS. For those of you relatively new to the Commission, JLARC is required to conduct an actuarial audit of VRS every 4 years, and we use a consultant for this purpose. The revised actuarial assumptions will be implemented in the June 30th, 2021 plan valuation, which will be completed this year and used to set employer rates for the upcoming 2022-24 biennium. The revised assumptions are estimated to decrease the funded status for the plan slightly and increase employer contribution rates, again, due largely to the change in the mortality assumption. Although any required increase in employer contribution rates may be lessened if strong investment returns continue. Importantly, the revised mortality assumption reduces the likelihood of a large rate increase in the future due to changes in the assumption. Mr. Chairman, one final topic that we have routinely updated JLARC on is the voluntary contributions for hybrid plan members. This issue is important because by design, hybrid plan members must make voluntary contributions to the defined contribution component of their plan to achieve retirement income replacement similar to members of VRS Plan 1 and Plan 2, which is considered likely to be a sufficient level of retirement income. However, looking at the most recent data, over half of hybrid plan members are making either no or the minimum voluntary contribution of 0.5%, and this is likely not sufficient to meet their retirement goals. VRS has conducted numerous outreach efforts and educational efforts, but contribution rates are unlikely to increase significantly without a statutory plan change, such as automatically enrolling new hires at a minimum contribution rate. And Mr. Chairman, that concludes my prepared remarks, and I would be happy to take any questions.
Members, do you have questions on the oversight report?
Mr. Chairman.
Yes, sir. Senator.
Thank you, Mr. Chairman. Just one quick question. When were the VRS changes to the mortality rate assumptions made?
So they basically did an experience study this year where they looked at the last 4 years of plan experience, and their actuary who conducted the experience study recommended to the board that they make the change to their mortality assumption. The board adopted them, and they will be implemented in the plan valuation that will be conducted this year for June 30th, 2021.
Okay.
And so that's the valuation that'll be used to set rates going for the upcoming biennium.
Okay. Follow up, Mr. Chairman.
Thank
Thank you, Mr. Chairman. Just one follow up. The VRS letter in the report, in the back of the report, sort of highlights a number of those changes. So some of those or all of those were adopted, or these are forward-looking recommendations?
I believe the recommendations that were mentioned in the report, most of them were adopted in the experience study.
Okay. Thank you very much.
Any other questions? Do we have a motion then to receive the report? Been moved by Senator Howell and seconded by Delegate Cyclicals to receive the report. All those in favor say aye. Aye. Those no. Kimberly, thank you very much.
Very good. Mr. Chairman, I'd now like to introduce Mr. O'Kelly McWilliams, who is the chairman of VRS's Board of Trustees.
Mr. McWilliams, always pleased to have you here, sir.
Thank you very much, Mr. Chairman. Good morning, Mr. Chairman and members of the Commission. My name is O'Kelly E. McWilliams III. It is my honor to be here today to share an update on the Virginia retirement system, which provides benefits and services to the Commonwealth's public employees. I have served on the board since 2017 and was appointed chairman by the governor in February 2020. As I begin my remarks, I'd like to share that VRS members have been a steady presence and positive influence in my life. Virginia public school teachers and university professors played instrumental roles as I pursued my education in the Commonwealth. And this continued through my law school career at George Mason University. Following law school matriculation, I had the honor of serving as a full-time law clerk for Judge Gerald Lee in the Fairfax County Circuit Court. I am truly grateful for the VRS members who have not only been educators, but quite frankly, mentors as well. The events of this past year and a half have only strengthened my admiration for VRS members, many of whom are working on the front lines across the Commonwealth to provide essential public services. It is a privilege to serve, especially as we emerge together from such unprecedented times. Now, I'd like to introduce our new board members. Since last July, Governor Northam has appointed 3 new trustees. First, Michael Disharoon, a Palladium Registered Investment Advisors. Next, Dr. Susan T. Gooden, Dean of the L. Douglas Wilder School of Government and Public Affairs at Virginia Commonwealth University. And last, and certainly not least, our most recent appointee, John M. Bennett, retired Vice President of Finance at Virginia Commonwealth University and former Secretary of Finance for Virginia and former staff Director of Senate Finance and Appropriations Committee. The members of the Board of Trustees share a dedication to the public employees of Virginia and continuously work to ensure that VRS is well positioned to meet both today's and future needs. As an agency, VRS has more than 772,000 active members and retirees. We're the 18th largest pension system in the United States and the 41st largest in the world. We take our responsibility to those we serve very seriously, and a healthy systems ensure we meet those obligations. We view as employers as our partners. The VRS benefit package helps them recruit and retain talent. We help our members plan for tomorrow, today, by providing benefits during their employment and the resource to learn about those benefits. For our retirees, we have an obligation to pay them on time, maintain their retiree benefits, and assist their families, especially at the most difficult times. And this was really demonstrated over the last 18 months. Part of ensuring a healthy system is having a long-term investment strategy. A year ago, amid a global pandemic and turbulent market conditions, it was challenging to predict the exact course of the future. But VR's long-term investment strategy prevailed. The health of the trust fund is strong. Because we remained steady in a chaotic environment and executed our mission to deliver value. We are confident we have well exceeded the assumed rate of return of 6.75% for the fiscal year. Since we're only a couple business days beyond the June 30th fiscal year, we're still receiving data from managers, and it's too early to provide a solid estimate of a final return at today's meeting. However, once we receive that information, we will immediately share it with JLARC. Our Chief Investment Officer, Ron Smith, who will follow me, will discuss the returns for April and May and will describe the strong progress we've seen in fiscal year 2021. With this impressive performance, the VRS Trust Fund has reached a historic high of approximately $100 billion. Compare that to $82 billion just 1 year ago, approximately a 23% increase. I'd like to reiterate that these are preliminary numbers, but at this point, I think all of us can agree the fund has seen robust growth. We're pleased to see a strong year, yet we continue to focus on long-term health of the fund. VRS has endured through good times and bad, precisely because our long-term strategy that focuses on the diversification of plan assets. This strategy also ensures a stable contribution rate for our participating employers. Our dedicated investment team see themselves as protectors of the trust fund, and they take that responsibility very seriously. Their efforts have provided an average added value to the trust fund of $246 million per year above the VRS board policy benchmark as of June 30th, 2020. Over 10 years, that's about $2.5 billion in excess dollars back to the trust fund. VRS also saves about $45 million a year in external management fees by directly managing about 1/3 of our plan assets in-house. Through well-reasoned investment strategies and administrative due diligence, VRS is able to consistently pay a monthly benefit to retirees and beneficiaries. In fiscal year 2020, we paid out $5.3 billion in monthly benefit payments. This serves as an economic engine to the Commonwealth. VRS continues to advance in providing members and retirees convenient and effective ways to plan for their future and manage their benefits. Retiring online is now available to most VRS members, with just-in-time counseling tips and holistic guidance as they go through the process. New My VRS features simplify and enhance security for tasks that previously required all paper forms. And our award-winning My VRS Financial Wellness Program offers savings, tips, and money strategies to help build strong, lifelong financial habits for our members. The value add of the investment programs, coupled with efficient customer service, helps VR rank consistently high when compared with our peers in CEM benchmarking, an independent benchmarking group, which Trish Bishop will provide some more details about. I'm proud of our staff and the speed and agility with which VRS successfully transitioned to remote work without disruptions in service or delivery. It's been a strong year. We're excited, and we look forward to continuing to build on these successes. Before I hand off the presentation to our CIO, Ron Schmidt, and VRS Director, Trish Bishop, I'd like to thank the Commission and the members of the General Assembly on behalf of the VRS Board of Trustees for your continued partnership, effort, support, and commitment. Your efforts to fully fund the VRS contribution rates are critical in helping sustain the plan and benefits for members and retirees. With your continued support, VRS can achieve its commitment serving those who serve others. I'm humbled to present to you today, and I appreciate this opportunity to address all of you about the success of a great year that we've had. Now, I'll have our CIO, Ron Schmidt. He'll provide an overview of our investment plan. Thank you.
Mr. Williams, while he comes up, I don't want to express, too, on behalf of the Commission, your good work over many years with VRS. So thank you, and
Thank you
members of
very
the board.
much. Thank you. Thank you, Mr. Chairman.
Thank you. Mr. Schmitz, you're not going to go through all these slides in detail, are you?
No.
Thank you.
Thank you, Mr. Chair. Good morning to the Commission. My name is Ron Schmitz, Chief Investment Officer of the Retirement System. I'm pleased to be here today to talk about the investment report, and I will try to be relatively brief. As usual, I include an outline of my slides here. Some of those I can comment on very briefly. Others will take a little bit more detail, but it won't be minutes per page, I assure you. Given the timing of this meeting, as the chair had mentioned, the availability of returns is shown here for most of the report through March 31. We do have an April report. We still are working on May numbers, and June, of course, just finished two business days ago, so it's a little tough to give fiscal year-end estimates, but the results are clearly strong, as the chair has indicated. If you look at this graph, it shows the fiscal year-end returns for each calendar year going back approximately 30 years. You can see if you look at the far right, that's the fiscal year-to-date number, so 9 months through March 31st. That's going to be one of the strongest fiscal years ever reported. I think by the end of May and June, it'll look a little better even than this slide shows. The contrasting horizontal line on the graph represents the assumed rate of return that's used for rate-setting purposes. That return assumption's trended down a bit over the last decade or so. It started out at 8% and has gone down in steps every few years. Is now at 6.75%. We'll be doing a forward return analysis with the Investment Advisory Committee in August. I think there's pretty strong evidence to keep that assumed rate of return at that level, but that will be something we officially discuss shortly. This is just a different way to look at the same 25 or 30 years of performance. This is annualized performance as of March 31st for each of the periods shown. You notice that the 1, 3, 5, and 10-year numbers are all above the assumed rate, owing in part to the very strong 12-month period we've just gotten through. This contrasts with the previous slide when you look at the individual bars where a number of the observations are actually below the assumed rate of return, but over time it tends to average pretty close to the assumed rate of return as evidenced by this graph. Looking at the longer term numbers, you can see that the annualized return is actually pretty close to the blended assumed rate, which is tapered down, as I mentioned, from 8% to the current 6.75. Importantly, each of these periods indicate that the portfolio has experienced excess returns compared to the risk-adjusted benchmark set by the board at the beginning of each fiscal year, and we feel very good about that result. Here's performance kind of showed in the more traditional way that we show in our monthly reporting. It's by total fund and by strategy or program classification over the last 10 years. If you look at the bottom rows, the total fund is highlighted in yellow. You can see that the fund has outperformed the board-established benchmark in each period this coincides with the slide Kimberly showed, by as much as 0.8% this year, 0.2% excess return in the 3 and 5 years, and a more typical 4% in the last 10. As a point of reference, the outperformance target established by the board in consultation with external third-party investment consultant is a 0.3% excess return. So over time, we've definitely hit that number. As you saw in the presentation from JLARC staff, individual asset class programs and strategies have generally performed quite well for March 31st. Those few that are lagging their benchmarks have seen better recent performance as the markets have generally rotated in our direction, and we'll have more on this in a few minutes. The upward return momentum continued in April, as shown by this graph, and instead of commenting on the total fund row, I'll comment a little bit on the right-hand side, the 1 year and fiscal year-to-date returns. Returns by both asset class and total fund are pretty strong on both an absolute and or a relative basis across all categories. As a reminder, the private market assets are only marked to market quarterly at the end of March, at the end of June, etc. So the April number doesn't include marks to market, just income received during the month. In the VRS review last December, there were some areas of the portfolio that hadn't quite shaken off the impacts of the early stages of the pandemic. Conditions in public equity, private credit, and real asset markets are now tilting in our favor, and the performance this year, ended 3/31, is doing well, as mentioned, 8.8% above benchmark, which coincidentally is a mirror image of last year when the portfolio was 0.8% behind the benchmark for the 1 year number. So what a difference a year makes. I wanted to talk a little bit about market rotation. I think Kimberly and or O'Kelly both mentioned that in their comments. The most dramatic rotation, it's affected several asset classes, but the most dramatic has been in equities. If you look across the board, you can see the S&P 500, which is the broadest equity benchmark, has had strong returns in all periods shown here, the calendar year 2020, the first quarter of 21, and roughly the last 6 months since the announcement of the FDA-approved vaccines. Though the broad market performed well, there was a pretty serious bifurcation in the markets between the growth and value styles of investing, and you can see that here by the highlighted numbers. More importantly, the disparity, just to define terms a little bit. Growth investing means firms whose earnings are growing faster than the general economy. They are generally expensive relative to current earnings, whereas the value strategy is stocks whose price is based relatively inexpensively priced based on current earnings and therefore is cheap versus the broad market. Longer term value tends to outperform growth. That hasn't been the case in the last couple of years, and particularly in 2020, I think in reaction to some of the economic uncertainties in the economy, the only stocks that were showing consistent growth were tech stocks. And just to illustrate that a little bit, you can see here the New York Stock Exchange FANG index was up significantly greater than every other subcategory of the market. This is really a handful of stocks such as Facebook, Apple, Netflix, and Google. So it was a very narrow market, and that unless you were fully weighted in those stocks, that your performance tended to lag, and most managers, active managers, did lag in the period. If we look at more recent numbers, you can see that the first quarter of 2021 was driven by value stocks outperforming, and indeed the rotation, as I mentioned, started last fall with pretty closely coinciding with the FDA approval of the COVID vaccines. And then while you can see that the FANG index, the tech stocks, are still performing pretty well, the market leadership has been taken over by value. This value dislocation that we've seen over the last 3 years, I think I mentioned this last year, is as severe as anything we've seen in multiple decades. We think there's a lot of room for that rotation to run, and that should be to the benefit of our portfolio. If we shift a little bit from performance, looking at asset allocation and risk positioning, all asset classes are within the board-established exposure ranges, and the key risk parameters in terms of volatility and statistical variation from the board policy are within pre-approved levels. As has been the case for several years now, the VRS portfolio is broadly diversified. Even though its largest asset class is public equity, there's meaningful exposure to several other types of investments. As such, the portfolio should not experience we often get comments about VRS portfolio returns versus the market. Typically, the speaker or the writer of the note that we receive is referring to the market as being the stock market. And typically in a bull market, our portfolio will underperform the stock market, and in a bear market, we'll do much better. That doesn't indicate that we're doing well or badly. It's just we're not the same as the stock market. In order to properly evaluate the VRS performance, you really need to compare the portfolio against properly calibrated benchmarks that includes all the asset classes that the board has approved for investment. Any long-term portfolio will have meaningful allocation to stocks. VRS is no exception, but in order to avoid that all eggs in one basket situation, VRS does use a number of different asset classes. As such, the portfolio won't experience extreme highs and lows that we sometimes see in the stock market. Our history confirms this. As I mentioned, we tend to lag a little bit the stock market in strong years, but we do significantly better in bear markets. This approach is in accordance with the Virginia statute and provides stable foundation that mitigates large swings in the contribution rates. So this is a busy slide, and it just gets to the point of diversification. Don't try to read the boxes, even if you could, if your eyesight is good enough to do so. Pay attention to the colors and how much the colors move around. There's no color that's consistently at the top of the page or at the bottom of the page. Basically, they kind of move around seemingly at random fashion. If you take the yellow box, for example, it's near the top in 2010, at the bottom in 11, at the top in 12, and so on. It just bounces back and forth. Many of the other asset classes or sub-asset classes do the same. It'd be great if you could predict the returns and buy and sell to take advantage of these ups and downs, but that's a very difficult proposition, if not impossible to do. Many have tried and failed to do so. We'll tilt the portfolio a little bit if things get out of whack from a valuation perspective, but we don't automatically react to last year's returns in one way or the other. Just the slide I just started showing last year, it's basically a compilation of hundreds of pension funds that report in through the various custodian banks across the country. I would note that VRS has a slightly better return than our peers at a significantly lower risk, which means that the staff's implementation is very cost efficient, translates to more stable contribution rates, as we've mentioned several times in the various speakers so far today. Since benefits are 2/3 funded through investment returns, our approach balances long-term gains and short-term risk. And our policy portfolio and underlying implementation strategies are calibrated to increase the odds of achieving the assumed rate of return over time. Early in June, the board adopted a new policy portfolio. This is not a change or an indication of a change in the risk-reward objectives. It's rather an ongoing shift toward the long-term policy that was adopted several years ago, 2013 in fact, in which the stock and bond exposure, public stock and bonds, were reduced over time in favor of increasing allocations to private market assets. And every June, starting for the new fiscal year, we kind of stair-step toward that long-term policy. You can see that in the policy target effective July 1st, essentially the board reduced exposure to equities and fixed income by 1%, raised the allocation to private equity and multi-asset portfolios by a like amount. As you look at the long-term policy targets on the right, you can see we're just about where the board wanted to go in their previous asset liability studies a number of years ago. We still have a little bit of work to do in terms of reducing public equity and increasing multi-asset portfolios, if indeed these relatively new strategies bear out and show themselves to be worthwhile. Next, I wanted to briefly talk about ways in which staff adds value to VRS. I'll begin with a few orienting comments about the next few pages before addressing this particular page. First, performance above benchmark adds value versus a passively managed portfolio. That value comes across the portfolio from all the different asset classes. Second, our overall fee structure is efficient in that the entire portfolio is internally managed versus an outsourced CIO model, in which a third-party fiduciary is responsible for the manager selection and all the portfolio movements in accordance with board set policy. Within that broad approach of internal management, we manage several stock and bond portfolios in-house, meaning we're actually buying and selling stock and bond securities and creating portfolios ourselves rather than through outside advisors. In the pages ahead, we'll discuss in-house management, the value added from those returns, and we'll discuss the fee savings, and which I think our chair has mentioned briefly. But to this page specifically, this is approximately 30% of the portfolio represents the in-house management, where fixed income and equity teams manage nearly $30 billion of the $100 billion portfolio. The amount of assets managed internally has declined just a little bit in recent years, in part because the fixed income portfolio, which had once been 100% internally managed, now has a small amount of external managers in some specialty categories, high yield and emerging market debt. And the overall move to decrease public market assets in favor of private assets has taken the amount of assets managed internally in-house down a little bit, but still a significant amount. In terms of performance, you can see the fixed income teams consistently added value over its benchmark. The degree of excess return over the past year has really been remarkable. I want to stress that the level of risk hasn't increased here. They haven't become gunslingers all of a sudden and got lucky. It's really a matter of that there were incredible swings in the various segments within the bond market caused by the pandemic and various reactions by the Fed and policymakers in Washington. The team was really adept at taking advantage of those swings and added an amount of value for the 1 year that's significantly longer than what we expect from them over time, over the long term. So we really were the beneficiaries of their good work. The equity portfolio has good longer-term numbers in both its low tracking strategies and low volatility portfolios. But as Kimberly mentioned, in recent years, it's been a struggle that gets back to that growth in value in the very narrow market that I discussed earlier. We're seeing that the value the market's rotated back toward value, and the market isn't being led by a narrow band of tech stocks today. Although in any given week, tech will have a run and a rally, but over time, we've seen the value reassert itself in basic industry, industrials, and those kind of stocks will, we think will do better for the immediate future. This graph just shows the number of ways in which we add value to try to make it a little more concrete than just the words I've used. If you look at the value by staff activity, we can break things down in a number of ways. The top left here shows the slide, and this is simply the total fund performance against benchmark. As mentioned earlier, the fund over 10 years has outperformed by 0.4%, which is $2.4 billion in the portfolio that wouldn't have been there under a passively managed approach, or stated another way, $240 million a year that comes from excess performance by staff. Second, on the top right of the slide shows implementation style. The light green and light blue wedges are traditional external implementation of private markets and public market strategies. The dark blue wedge represents in-house managed assets in the case of public markets, and the dark green is private market implementation in co-investments and other fee-advantaged private market activity. The bottom two portions of the slide are provided to us by Cost Effectiveness Measurement Service, CEM, an independent organization that measures hundreds of pension funds globally along a number of investment and administrative metrics. CEM calculates, and I think this was repeated earlier, so apologies for the repetition, but in-house management saves $45 million a year in fees that would have otherwise been spent on external managers. And CEM also calculates an implementation efficiency that shows that VRS pays less for the same services that other pension funds use, and that saves about $47 million a year. Note that the figures on this page are slightly different time periods if you're reading closely. The value add slide, the top left, is calendar year 2021. The CEM data is, was for the year ended, the period ended 3/31/21. The CEM data is for calendar year 2019. CEM's in the process of gathering 2020 information, which we'll be reporting later this fall. Last, just a couple of slides about the markets and the economy as we look ahead. JLARC staff usually asks me to do that. For that and $5, you can go buy a coffee at Starbucks. But I've been asked to do it, so I will. We'd like to conclude with just a few comments. I think there are certain isolated pockets of the market that are disruption, that are facing a little bit of disruption or that could be materializing. Really, the market, the economy is trying to roar back out of the pandemic. We haven't quite recovered what was lost from March last year fully in terms of economic activity, but the direction of the economy and the robustness of the economy in recent months has been quite strong. and the stock market is reacting even more stronger than the economic fundamentals. A couple of areas of interest, we're paying attention to asset class valuations. Most asset classes are expensive, and that concerns us, so we're watching that very closely. Right now, the stock market is fairly expensive, but earnings projections are looking pretty strong, so that makes us a little more comfortable with that aspect of the valuations. Other things that we're looking at are monitoring closely are the evolution of inflationary pressures and that market rotation from growth to value that I had mentioned earlier. And just a slide or two on those 2 points. This teal-colored portion of the graph on the left, that shows the earnings proportion that was dominated by growth-style investing in tech stocks. And you can see that it dominates the other styles or the other type of stocks in the markets for that time period. The dark blue portions of the chart on the right have grown significantly from 26% to 62%. Those are cyclical companies such as basic industry, energy, and financials. Those tend to be the stocks that are favored more by value-oriented approaches like ours. And as I mentioned, over the last 6 months, those stocks have come roaring back. We think earnings are expected to grow. This is from an outside source, not our projection. And if earnings grow, the valuation of those stocks will grow, and that should benefit our portfolio. Quick comment on inflation. There's kind of a debate going on in the investment world about inflation. Many observers think that there'll be transitory inflation, meaning short-term inflation in certain pockets of the economy, but not necessarily sustained or high inflation across all areas of the economy. Others believe that inflation will be higher and more long-lasting, and that the Fed is kind of mismanaging the pressures that are building now with poor downstream consequences. We tend to lean toward the transitory side. We don't think there's long-term highly sustained inflation pressures. And even if there are inflation, if inflation runs a little higher than it has in recent history, we don't think that's particularly problematic. Productivity, capacity utilization, labor supply, all will serve to dampen inflationary pressures, and we don't see a F-70s era type of hyperinflation anytime soon. I wouldn't be surprised if inflation rose a couple percent from the Fed's target of 2%. But I don't think that's necessarily a bad thing. It'll dampen stock returns a little bit potentially in the short term, but as the economy kind of gets used to those levels of rates, everything I think will smooth out and be better. So just one last quick summary slide in conclusion. I'd like to reiterate my earlier comments. I'm pleased to share a report that has a lot more positive tenor than last year's report. The economy is bursting out of the pandemic with great pace, and several of the headwinds we faced in the portfolio last year are recovering, both in terms of broad markets as well as within the portfolios that we manage. Relative performance is solid. We continue to improve. The value rotation in the equity portfolio is something that we think will take place over several months and even years. There may be fits and starts where tech stocks kind of make a comeback, but we think those will be short-term and transitory. The board's continuing its measured phase-in with the long-term policy, and I think we'll be there within the next year or so. Again, which de-emphasize public stocks and bonds and put more money into private markets where there are better risk returns and a better risk-return trade-off. Last, we believe the risk posture of the portfolio will allow good participation in strong equity markets while mitigating the downside in bear markets. And with that, I thank you for your kind attention. Happy to take questions if there are any.
Questions, Mr. Schmidt?
Mr. Chairman.
Senator Howell.
Thank you. What a wonderful report. And I know a lot of hard work went into getting these great results, so thank you. I do have I'd like you to help me explain to my constituents something. From time to time, I get emails saying that the General Assembly should require certain investments by the VRS. And specifically last week, I got one saying that we should require about 20% of your investments to go to Virginia-based clean energy companies. Can you explain to my constituent why we can't do that?
Well, that is a loaded question. We have generally found, and there's a lot of evidence to support this across the country, not just VRS, targeted mandates usually don't work. They sound good, they look good on paper. They don't accomplish the investment returns that you need if you're doing an unencumbered portfolio. There are a number of examples of that. I could rattle off some states. Oregon, where I came from, tried to do it in technology a little bit. Some other states tried in-state investing, Missouri for one that comes to mind, and had really a pretty abysmal time from it. If you restrict a portfolio either by, for example, I was half expecting you to go to fossil fuels, but if you restrict a portfolio by not investing in fossil fuels, you basically take away an investment opportunity, and doing that over time tends to hurt the portfolio. You can't do X minus 1 and expect to do as well as X. That doesn't mean we're pro fossil fuels or that we overload fossil fuels. In fact, we are underweighted. But those kind of restrictions generally hurt the portfolio more than help. And the same thing with targeted investments. If you force the portfolio to go into a direction, you're kind of throwing money at something that may or may not represent a good value relative to other investments. And our fiduciary duty is to invest for the benefit of for the exclusive benefit of beneficiaries. And beneficiaries, in our case, we think that means the best risk-return reward we can get.
Senator Howell.
Trade-off that we can get.
Yeah, just to follow up, at the end, I believe you said where I thought you were going to go in the beginning, but that's a constitutional requirement, isn't it?
It is, yes. I can't state the statute, but I know somebody back here can.
Okay. Thank you.
Other questions?
Mr. Chairman,
Yes, sir.
I guess as a follow-up to Senator Howell's question on fossil fuels, certainly the Hampton Roads is, according to the National Ocean and Atmospheric Administration, the second most vulnerable area, second only to New Orleans in terms of flooding. Obviously, the port, the operations, the jobs, the base, DOD spending represents roughly 40% of all jobs within the area. And over the last 50 years, roughly, we've added about 14 inches of water to the wrong side of the equation. So other states have divested in fossil fuels. You seem to be prepared for the questions. Can you elaborate on what that would look like, whether the board has considered it, and what the impacts based on certainly Virginia's economic dependence and the criticalness of the Hampton Roads region to our economy?
Sure. We generally believe that, and the board's philosophy is on a number of things, where there's a Iran, Sudan, tobacco, fossil fuels. Forcing a portfolio to divest, again, is taking away an investment opportunity. Even if you mandated, if fossil fuels were mandated federally from being used, the transition, I think by most estimates I've seen, is 20, 30 to 40 years. That fossil fuels will still be around. There's been a big move to transition from quote unquote dirty coal and more toward clean gas, which I think is very much a step in the right direction. I think there's a lot of movement going that way. The oil companies themselves are moving quite a bit that way. But again, we think it's a little self-defeating to mandate the portfolio to avoid something or to make specific investments.
I guess, Mr. Chairman, one follow-up. I hear the difficulty. Other states are doing it. Maine just passed a requirement as well. As the staff began to consider if Virginia did divest in fossil fuels, what would that look like in the time frame?
We haven't specifically done calculations on what it would look like. We are doing some climate-oriented strategies within the portfolio to get a toe in the water to see how those look, how they work, how they perform. But again, I would call that toe in the water. It's not a massive shut off the spigot, as it were. We haven't again. We're looking at that in kind of more of a microcosm sort of way within a portfolio strategy. This happens to be an equity-oriented strategy. Our private market activity that has energy-oriented investments is doing renewables. So that, there is investment going into whether it be wind or solar and other options of renewable energy. So there is a movement in that way, but we haven't looked at something that's just kind of a forced cutoff. But we certainly could do that.
One final question, Mr. Chairman. Thank you. If a pension VRS participant reaches out to us and says, I'd prefer not to have any of my dollars invested in fossil fuels, do you have a viable option that they can go to, a portfolio or other things that they can select under my VRS to invest in?
Within I'm going to get out over my skis a little bit here. Trish probably could better answer that, but within the pension portfolio, we don't have that option. It's everybody gets the portfolio, all the assets from the different systems are consolidated. In the 457 plan and the hybrid plan and so forth, where they're self-directed, there are brokerage window options that could be utilized to do something like that. And I hope I didn't misstate that. But
Other questions? Thank you for your report, sir, and I think you can expect that probably those same questions will be asked again next session
I
next time when you
suspect so.
make
We'll
your
have
report.
we'll have a little more
Yeah.
thoughtful
I
answer.
think we're going to hear now from Director Bishop.
Good morning, Mr. Chairman, Madam Vice Chair, members of the Commission. I'm Trish Bishop, Director of the Virginia Retirement System. I'm delighted to be here this morning to talk a little bit about an update of the how we carry out our mission at VRS. This slide is not new to you. It really represents our members, the nearly 772,000 folks that we serve. You'll recall that we administer Plan 1, Plan 2, and the hybrid retirement plan. Essentially, Plan 1 and Plan 2 are closed to new membership, with the exception of hazardous duty folks who new employees generally go into Plan 2. You'll also note that the largest group is our active group is our teachers. Political subdivisions are our next largest group, with state employees the third. And also it's important to note that the hybrid plan is generally the new plan for employees. It's growing quickly, and it composes about 1/3 of our active population. Just as a reminder, the hybrid retirement plan has two components, a defined benefit component and a defined contribution component. The defined benefit component is a foundational portion of the benefit and is more like the pension plan, and the defined contribution component is more like your 401k in the private sector. The DC plan, which is portable, requires mandatory employer and employee contributions and allows for voluntary contributions by the member with employer matching funds. Just by way of background, following the Great Recession, the General Assembly created the hybrid retirement plan, which is a model that shares risk between the employer and the employee. And to illustrate, the hybrid retirement plan reduces employer investment risk by about 1/3. With the defined contribution component of the plan, the hybrid provides that additional portability, which is viewed positively by our members. And the hybrid plan's different age, service, COLA, and multiplier provisions also lower the future costs of benefits for the plan. As I shared earlier, the hybrid plan is indeed growing. There's about 128,000 active hybrid plan members. Again, the largest group here is the teachers. Most hybrid plan members are relatively new to their positions, just over about 2.5 years of service. And they're relatively new employees, their average salary is about $45,000. And that's important as we think about those voluntary contributions that they are required, that they would be want to make to increase their benefit. So this slide, we are often asked about member outcomes within the hybrid retirement plan. And this slide tries to graphically depict how that works. So on the left side, you'll see Plan 1 and Plan 2 that have an income replacement ratio of about 50% after a 30-year career. On the right side are various scenarios within the hybrid retirement plan. So the blue and green bars, the blue portion of the bar represents the DB, the green portion represents the defined contribution portion of those plans. So if a hybrid plan member doesn't make any contributions, that's that short bar sort of in the center, which would generate an income replacement of about 36%. If they're making consistently over that career 2% voluntary contributions, they can generate income replacement about 46%. On the far right, if they're consistent and they're making the maximum employee voluntary contribution over the course of their career, they can generate a benefit of about 55%, which is higher than Plan 1 or Plan 2. So I think in summary, and as Kimberly alluded to, voluntary contributions are key in a member's benefit, and as those voluntary contributions increase and those employer matches increase along with them, the benefit correspondingly increases. So how do, and Kimberly alluded to this earlier, how do plans effectively increase savings rates so that employees can achieve those higher income replacement ratios? While we use a variety of communications and outreach and education, we know from the literature as well as experience that those automatic tools are the most effective ways to increase and improve outcomes. And so the hybrid retirement plan already uses an automatic feature. It uses auto escalation at every 3 years. However, back in our 2015, when we developed a cash balance report, we talked about a few options that could be available to the legislature, because this is a statutory plan, for you all to consider to improve those outcomes. And one would be accelerating auto escalation from every 3 years to every 2, but also pairing that with auto enrollment into the voluntary portion of the plan. In addition, the legislature could consider changing the allocation of the mandatory contribution from the current structure to a proposed 3% to the defined benefit plan and 2% to the DC plan, which would allow more contributions by the employee to go into their defined contribution plan. So I'll pause there if there are any questions.
Yes, Senator, Delegate Cyclicals.
Thank you, Mr. Chairman. I'd like to ask, is there any evidence as salaries go up that the contribution percentage increases?
Yes. Yes, Delegate Cyclicals, there is a correlation. It's highly correlated with salary. We have some data regarding how our participant behaviors are. And it also, interestingly, in the state plan, it also varies depending on what type of agency you're in. It's not a surprise that the finance agencies tend to have higher deferrals. So there are correlation but salary is an important driver. It is even more important than years of service. Hope that helps. Okay. Continue?
Go ahead.
Okay. We've talked about members of the plans and plan design, so now let's focus on the measures we use to monitor the health of the plan. One commonly used measure to gauge the health of a plan is funded status. The funded status is the ratio of assets available to pay benefits compared to the plan's liabilities. This is the funded status of the state plan. The green bars represent a future estimate of the funded status. And also should note that the state plan was 72.9% funded as of the last valuation. We expect with robust returns this year that funded status across all our plans will meaningfully improve. This is the funded status of the teacher plan since 2005. It shows roughly the same pattern as the state plan, and the teacher plan at June 30th last year was 71.7% funded. And finally, we'll show the political subdivision plans in aggregate. And you'll notice that they are a bit better funded than the state and teacher plan. And that is largely in part because they have been required by statute to pay the full actuarially calculated board certified contribution rates over time. And we're not subject to that underfunding. And so they're actually about almost 84% funded in aggregate, despite having more folks who have more expensive hazardous duty benefits. So this chart's a little bit busy, but really it shows how the assumed investment rate of return has changed over time. And this is a key element underpinning funded status. And so you'll see that VRS at 6.75% is among the lowest across public plans. And public plans have been lowering their discount rates over time. And this just tries to show you a comparative of where VRS stands in terms of funded status and our assumed rate of return compared to other states. And the most recent comprehensive data available was from 2019. But the important thing here to note is that there's really only one state who has a more robust funded status than VRS, but has a lower, uses a lower discount rate. So if you normalize that discount rate across all the plans, we would actually have moved up in the funded status. So sometimes it's one of those things where it can be deceptive. You can think, oh, that other state is doing better, but if they're using 8% as their discount rate, they might be using too rosy a colored glasses. So this slide shows you the contribution rates that you have funded for across all of the plans, and these will be in place through 2022. In the fall, as was mentioned, we'll be setting contribution rates for the upcoming biennium. And we expect that contribution rates will remain relatively stable in the upcoming biennium. This graphic shows you sort of how contribution rates are developed, and they include a variety of elements, including the recent results of the experience study that we did this spring. All of those elements go into the actuarial valuation and then the development of the contribution rates, which are considered through the budget process or distributed to our political subdivision employers. So I think Kimberly went through this a good bit during her presentation, so I'll be brief here. But during our experience study, some of the most significant change to our assumptions was using new mortality tables that are specifically developed for public employee population, and we've moved to this also generational mortality tables, and that means that we assume that future generations will be living longer. And so what does this mean for rates going forward? In most cases, all things being equal, contribution rates would increase. However, the strong positive investment returns will likely mitigate those increases. And as a result, we do think that contribution rates will remain relatively level despite the change in the mortality assumption. So we're always asked what the pension liabilities are for the plans, and the total unfunded liabilities on an actuarial value of assets or a smooth value assets is $20.8 billion for the statewide plans and $3.4 billion for the local plans. And it's important to note that there's a structured plan in place to pay off those unfunded liabilities over time. So this slide is designed to kind of help explain what has happened since 2013 with respect to our unfunded liabilities. On the left side is a solid blue bar, and it represents what we're calling the legacy unfunded liabilities as of 2013, and that was $7.5 million for the state plan. On the right, or the hatched blue bar, are the unfunded liabilities as of June 30th, 2020. So new liabilities since 2013, so when experience doesn't match assumptions, could be a gain or loss, and that's that blue bar. In this case, it's a gain. When underfunding takes place or when the discount rate is lowered, that shows that other bar where there's an additional change. So the takeaway on this slide is that with the General Assembly now fully funding contribution rates for the state since 2017 and the teacher plan since 2018, no new liabilities are being generated due to plan underfunding. That's a good news story. Total unfunded liabilities are on a payment schedule, so ongoing progress is being made to pay down those legacy unfunded liabilities. And since 2013, plan experience has been net positive by about $1.1 billion. So the funding policy, plan design changes, and your efforts are indeed making a positive difference.
Let's pause there for a moment, see if there are
Sure.
questions. You have questions on this segment? Dr. Bishop, the enhancing customer service is very important. I know you're proud of the work that you all are doing, as you rightly should. If you can kind of summarize that for us, I'd appreciate it.
Sure.
Thank you.
Happy to do so. So I think what I'll probably share is the biggest milestone we've had is we now have online retirements for our members. That includes a holistic counseling approach that helps them make their decisions and gives them counseling embedded in the feature. I think more online enhancements are on the way, including how folks can manage their direct deposits, their beneficiaries, their health insurance credit, and have survivor access. Oops, won't go forward. I'm not sure why. Thanks, Jeannie. We have provided financial wellness to our employees because we know that one of the number one stressors in the workplace are financial concerns, and that is all free through their MyVRS portal. And as we consider the services we provide, we've been given national recognition for both our outreach, education, and our financial wellness efforts. So, and I'll wrap up with our peer comparison to talk a little bit about our service delivery compared to our peers, and in our view, what gets managed, what gets measured gets managed, and we think our results are fairly compelling. Again, this is data from CEM, works with over 400 funds worldwide and performs benchmarking. According to CEM, VRS pension administration costs fall $22 below the peer average of $103. But cost isn't the only important issue. When comparing VRS to other U.S. peers, our service delivery score of 82 exceeds the peer median. So finally, this last graph plots both service and cost effectiveness, and the yellow arrow indicates where VRS falls in that favorable quadrant where we're providing high service at a low cost compared to our peers. For well over a decade, we have found ourselves in that peer, and we're proud of the work that we've done to do so. So in conclusion, we are honored to serve the Commonwealth's public servants. We continue to innovate to try to help our members plan for tomorrow today. And this concludes my prepared remarks, and I'd be happy to answer any questions.
Okay. Any questions then of the director? Well, we thank you again for your report, and thank you for the good report that you have. So thank you.
Thank you, Mr. Chairman.
Hal, I'm going to ask you if you'd introduce the next segment.
Yes, Chairman, I'll turn it over to Kimberly Sartay, who will do so. Kimberly?
Thank you, Hal. Yes, Mr. Chairman. Next, we will be turning to the Virginia 529 portion of the meeting. So first, you will receive the findings of an actuarial audit of the prepaid 529 program. Prepaid 529 is a defined benefit program that allowed Virginia residents to purchase prepaid college tuition contracts. This program has since been closed and replaced with a new defined benefit program called the Tuition Track Portfolio. However, Prepaid 529 will still be paying out on existing contracts for the next 20 or so years, and JLARC is statutorily required to conduct an actuarial audit of the program every 4 years. So today's audit was conducted by GRS, who is JLARC's actuarial consultant, and the purpose of the audit is to assess whether the fund is actuarially strong. A key finding that you're going to hear is that Prepaid 529, with a funded status of 157%, is actuarially sound and in fact has more than sufficient assets to cover the actuarially determined value of future tuition obligations. And as a result, the fund currently has a surplus of $1.1 billion, which is expected to grow to $3.8 billion in 2044 after all tuition obligations have been paid based on current actuarial assumptions. So given this large surplus, Mr. Chairman, we feel that the fund is really at a point where it really needs to be considered whether a portion of the surplus, certainly not all because prepaid needs to stay actuarially sound, but a portion can be used in other very meaningful ways, such as maybe providing financial aid for disadvantaged students. We think that there likely is some latitude in how the funds can be used, especially because in addition to the sales of prepaid tuition contracts, there have been other sources of funding that have contributed to the surplus that have nothing to do with the prepaid program. So, Mr. Chairman, we just wanted to provide you with that important context. Next, I would like to introduce Lance Weiss and Amy Williams, who are the actuaries from GRS that conducted the audit, and they will be presenting to you actually virtually from Chicago. I guess, are they up yet? And Mr. Chairman and members, so they will be able to hear you if you have any questions, but you need to speak into the mic and make sure the mic is on. But they are happy to answer any questions or field any comments that you have.
Welcome to our Chicago.
Well, thank you, and good morning. Can everyone hear me?
Yes, we can hear you. You may proceed.
Thank you very much. Well, good morning, Mr. Chairman and members. My name is Lance Weiss. I'm a senior consulting actuary with Gabriel Roeder Smith & Company, consultants and actuaries. I'm joined by my colleague, Amy Williams, today, and we're here to present the results of the 2021 quadrennial actuarial audit of Virginia 529 prepaid 529 program. So before we get into the results, I wanted to kind of give you a real quick executive summary And Kimberly, thank you very much for doing that for me. But as Kimberly said, prepaid 529 is actuarially sound, and it has more than sufficient assets to cover the liabilities, the tuition obligations. As Kimberly said, prepaid 529, as of June 30, 2020, has a funded ratio of 157.4%. And that means that assets represent 157.4% of the liabilities. The funded surplus in dollars at that point, at June 30, 2020, was $1.1 billion. And the projections are that that 1.1 billion will increase to 3.8 billion at the end of fiscal year 2044, after all obligations have been paid. In terms of the results of our audit, we looked at the actuarial assumptions, and we believe those are reasonable. And also, as Kimberly mentioned, we need to tell you that prepaid 529 was closed to new enrollments as of May 1, 2019, and then effective February 2021, Virginia 529 launched the tuition track portfolio called in other terms, TTP, as a replacement for the prepaid 529. So in terms of what we're going to talk about real briefly today, the background and purpose of an actuarial audit, our audit conclusions, and then some considerations and recommendations going forward. So in terms of, why do we do this audit? Well, number one, we do it because it's required in accordance with the Virginia College Savings Plan Oversight Act. And so GRS, Gabriel Roeder Smith and Company, was retained to conduct this 2021 quadrennial actuarial audit. And the purpose of the audit is, as Kimberly said, to provide the General Assembly with a comprehensive overview of the actuarial soundness of prepaid 529. And I want to mention that this audit was completed with full and willing cooperation of the Virginia 529 staff and the retained actuary Milliman. And we thank them very much for that. In terms of the audit itself, we performed what we call a non-replication actuarial audit. That means we didn't do a full-blown actuarial audit, but we reviewed various components of the plan. And in terms of what we reviewed the reasonableness of the funding results and the conclusions from the actuarial audit that Virginia 529 and the retained actuary conducted. We looked at 16 sample contract holders, over different, different types of people to validate the overall results based on the stated assumptions and methods. We reviewed the assumptions, methods, and underlying data that was used to produce the valuation results. We reviewed the content, detail, format, and clarity of the actuarial valuation report that was prepared by Virginia 529's actuary. And then we also looked at whether the actuarial valuation was performed in compliance with principles and practices promulgated by the Actuarial Standards Board, which is the board that can provide standards for all actuaries operating in the U.S. that needing to be followed. In terms of our conclusions, we found that the results and conclusions in the 2020 actuarial valuation of prepaid 529 were reasonable. As already indicated, prepaid 529 has more than sufficient assets to cover the current liabilities. And I mentioned that it's 157.4% funded with a funding surplus, again, as of June 30, 2020 of $1.1 billion. The Virginia 529, prepaid 529's actuary projected that the prepaid 529 would have a surplus of $3.8 billion at the end of fiscal year 2044, after all obligations have been paid, and we confirmed that. We also looked at whether the contract data supports the results, and it definitely does. And we looked at whether the valuation was conducted in accordance with generally accepted practices for actuaries, as well as with the practices promulgated by the Actuarial Standards Board. And in fact, yes, everything was conducted appropriately. In terms of conclusions, again, we looked at the actuarial assumptions. We believe the actuarial assumptions and methods are reasonable. We think the investment return assumption is reasonable and falls in a range of reasonable assumptions. We think the inflation rate assumption falls in a range of reasonable assumptions. However, it is at the high end. And also the tuition increase assumption, we believe falls in a range of reasonable assumptions, but also again, at the high end of the range. So we recommend that because some of those assumptions are kind of at the high end and an experience study has not been conducted in the recent past, we recommend that Virginia 529 and Milliman, their actuary, conduct an experience study within 12 months to review the economic and demographic assumptions. We also recommend that they pay special attention to the tuition increase assumption, the inflation rate, and the reasonable rate assumption, which is used if beneficiaries do not attend a Virginia public institution or if they roll their funds over into another college savings account. We identified some very relatively minor suggestions, recommendations for Virginia 529 and Milliman to refine and add clarity to the actuarial valuation. And I won't get into these because these are kind of detailed, but really it's just to add some refinement and clarity to the results. And then as Kimberly already mentioned, and I mentioned, prepaid 529 was closed to new enrollments and Virginia 529 launched as a replacement the tuition track portfolio, the TTP, and according to Virginia 529, these two programs will be combined and the assets will be commingled for investment purposes. According also to Virginia 529, there will be one actuarial valuation report prepared in future years for the combined assets and programs. And given those given those purposes, we recommend that the next audit of the combined TTP and prepaid 529, that special attention be given to the actuarial assumptions for future tuition increases. And also we'd like to see more detail on the impact of the funded status of the combined program from now the inclusion of TTP with the prepaid 529. So that kind of concludes the highlights of our report and audit. We'd be happy to address any questions at this point.
Thank you very much, sir, for that report. Are there questions of the actuary? Hearing none, sir. I appreciate your participation today and your comments. Thank you.
Thank you.
And Kimberly?
Yes, thank you, Lance and Amy. Next, Mr. Chairman, I'd like to introduce Mary Morris, who is the CEO for Virginia 529, and Michael Wynn, who is Investment Director, and they are here to give you their annual report.
Thank you. Mary, welcome.
Thank you, Kimberly. Put my glasses on so I can see. Thank you, Mr. Chairman, members of the Commission. Thank you for the opportunity to meet with you this morning and review the activity at Virginia 529 during the past year. My appreciation, as always, goes to JLARC staff and the GRS team on the quadrennial audit. As you just heard, they found that the conclusions in our valuation report generally are reasonable. The primary actuarial assumptions are reasonable, and the prepaid program is actuarially sound. The report contains what GRS has called minor recommendations to consider, and we generally agree with those conclusions. We either have addressed or are addressing for this next valuation report, excuse me, each recommendation. And you can see our response letter to the GRS report dated June 10th for more detail. I'll have some comments on the funded status and steps that we think we're taking internally to address that status when I discuss our enhanced access and affordability initiatives. And I do note that the projected surplus assumes that all the assumptions remain static for the next 23 years. And so although our funded status is quite enviable, we are pleased with that. I do just make a couple of notations on that. As we know, the last 18 months have been challenging for all Virginians, and as well as the nation and the world. However, people did not lose faith in our systems or the future, and we saw continued growth in programs and in assets under management as the markets largely continued to fare well during the pandemic. In fact, it appears that our assets under management will have increased year over year approximately 40% when we finish all the calculations for year end. And our account growth has been year over year, looks like about 12% increase in our Invest 529 program. And that's about double what the national average was as we went into the final quarter. You'll note a shift in my emphasis this year as I address our 25th year of providing education savings solutions for Virginians and update you on the recent evolution of the prepaid 529 program, our legacy, to the tuition track portfolio, or TTP, within the Invest 529 program. Then I'll widen the lens to cover the growth in our mission entrusted to us by the General Assembly in recent years to provide able disability savings programs in 2015, and to develop and implement a state-facilitated retirement program to assist many of the more than 1.2 million working Virginians, almost half the workforce, without access to a retirement savings option at work. In addition, I will review some of the board-led activities to further expand our statutory mission to enhance access and affordability of post-secondary education for all Virginians, moving beyond the SOAR Virginia program, which is entering its second decade. So starting at the beginning, with the mandate and program that opened 25 years ago in 1996, is a discussion of the evolution of the prepaid 529 program. In recent years, you all have heard much about this program, its many successes and its limitations. And in 2019, you authorized changes to the program, which were endorsed by a review by JLARC staff, to develop a new kind of defined benefit program, which would be more affordable and more accessible to a greater number of Virginians. In designing this new offering, we also focused on flexibility and ease of use across the many platforms for higher education available today. The tuition track portfolio was developed to meet these new challenges, and it opened in February 2021 as a portfolio option within our successful Invest 529 program, instead of being a standalone program like Prepaid 529. TTP, however, remains a defined benefit option, tracking as it does average tuition at Virginia's public universities. So the assets of Prepaid 529, which will continue unchanged for the remaining 55,000 plus accounts and contracts that we have, and TTP are combined as the defined benefit 529 programs, and you'll start seeing that in reporting and in financial statements and the like, and commingled for investment purposes. To be more affordable and flexible, TTP is available in units, with the value and cost of a unit tied to average tuition at Virginia public universities. Gone are the semester minimum purchase and installment contracts and financing charges of the prepaid 529 program. One TTP unit is equal to 1% of average tuition. Stated another way, 100 units equals 1 year of average tuition. I have some examples on the next slide that will show a little bit of how that works. Participants can open an account with as little as a $10 contribution and purchase a fraction of a unit. The price per unit for the upcoming academic year, 2021-22, will be $138.84. That represents a 1.8% increase over the initial enrollment period through June 30. Additional contributions purchase units or fractions of units up to 1,000 maximum units. The unit value is always tied to average tuition. The value will always be the same regardless of the kind or location of a school or program, and units may be applied to any qualified higher education expense. Those are some of the significant changes between the tuition track portfolio and the prepaid program. Our initial experiences, and that's what you see on this slide, is encouraging. After only 5 months being open, this portfolio has shown the fastest growth of any Invest 529 portfolio since it opened almost over 20 years ago. And we're seeing purchases across a broad spectrum or number of units. You see in the green in the top pie chart, most units are being purchased in that 0 to 25 category. And this goes to what we had believed and we're seeing prove out, that prepaid wasn't as available to as many Virginians because it simply had gotten too expensive. When you can purchase units and when you can purchase smaller numbers of units, we're finding more participation at that lower end. The average number of units per account is ranging about 80, so we're also seeing some nice pickup in larger amounts. We expect that'll come more. Our June numbers aren't in. We had to prepare this. We added probably another, I'm trying to think how many it is. We have about 2,500, about 700 more accounts in June. So we're at about 2,500, almost $33 million invested. You can see the average beneficiary age remains remarkably unchanged year over year, depending on the program. It averages about 8.4 years. We get a lot starting younger, but we get a lot starting later, so it averages out to that 8.4. I know this next slide is a bit of an eye chart. It's hard to read. I'm not sure we can't get it any bigger, but it helps demonstrate the flexibility of the TTP and how units may be applied. You see in the middle of the page, and look for the green bar right there in the middle of the page, that's average tuition. So for 4 years, that's equal to 400 units. You see also that the majority of public universities in Virginia fall below the average tuition, including, of course, Virginia's 23 community colleges. So with 400 units, if someone purchases that, which would have been a 4-year prepaid contract in prior years, applied at any of the schools below the line, TTP will cover not only tuition and fees, but additional expenses. For schools above the line, a participant will need to make up the difference in some way, including with more TTP units. So as you can see from the chart, with TTP units alone, the full cost of tuition and fees at any Virginia public university may be covered. In addition, the full cost of tuition and fees for the average private Virginia university may be covered. That's near the top of the chart. Even average tuition and average room and board at Virginia public schools may be covered with TTP units. And that's the 2 green bars there in the middle and the lower portion of that. So it provides, again, a lot more flexibility for parents and grandparents and others who are purchasing these programs to decide how to use these accounts, to select the right school for their student, to select the right program, and to apply available funds as the account owner chooses. And we're finding this is a very popular feature of this program. I'll sort of stop here. This finishes the education piece of what I wanted to talk about. And if there aren't any questions, or I can always come back, I'll move on to briefly talk about our Able Disability Savings Programs. This is part of our expanded mission. It's a much more recent mandate for Virginia 529, and we continue to grow and refine the program. We offer both a direct ABLE program, ABLE Now, which opened in 2016, and an advisor option, ABLE America, which opened in 2018, with our education savings partner, the American Funds. Together in the last 5 years, we've grown to have the 2nd largest ABLE program in the country and the largest independent program. ABLE programs across the country have seen a slower build than predecessor education savings programs. Much of this is due to continuing federal limitations on growth, including annual contribution limits, Medicaid payback requirements, age of onset limitations, and single account restrictions. Our ongoing legislative efforts at the federal level, particularly with respect to the ABLE Age Adjustment Act, hopefully will end well, and we'll have more opportunities to grow the program. But working with what we have, we continue to work also with our partner in this program, PNC Bank, to enhance the ABLE Now program and increase participation. In 2021, we became the first program to offer a mobile app and mobile wallet solution, both of which have been popular. We've enhanced our funding at enrollment opportunities, and we're refining a group home onboarding process, which has great promise for growth in this arena. We continue to build awareness through digital and media, and we're looking forward to commencing again soon, we hope in 2021, in-person engagement with our customers and potential customers, not just in our ABLE programs, but in education savings as well. Move on now to expanded access and affordability. More than 10 years ago, the General Assembly supported our access and affordability initiatives with legislative changes that led to the opening of the SOAR Virginia Early Commitment Scholarship Program, now in its 11th year of operation. And you have some information on that program and what it's done in the appendix to this. In the year since it opened, with just a few schools and students as a pilot program, it's grown to assist more than 3,500 students each year in grades 10 through 12 in Virginia public high schools. The program works with 6 college access providers across the Commonwealth in some of the most challenged schools in the state. As our education savings programs have grown, as our funded status and prepaid has expanded and improved, so is our ability to expand efforts to enhance access and affordability for all Virginians, which has been in our statute, part of our mandate from day one in 1994 when our legislation was first passed. The Virginia 529 Board, in recent months, really going back into early 2020, has taken deliberate steps to identify ways and programs which will advance student success in Virginia. One of the things that we've done to help with the funding of these programs is that as our funded status in the prepaid program has grown, it has allowed us to stop allocating net operating revenues to the prepaid program, which we did for a number of years, and allocate those now to some of these access and affordability initiatives. And so we think over time that's a way to address and really fulfill our larger mandate to help all Virginians as we also provide affordable, economical, and good programs for all Virginians. Our efforts are aligned to the Virginia Plan for Higher Education outlined in the SHEV Strategic Plan and with the recently adopted G3 program, the successful Fast Forward program, and other state programs. The board's focus is on providing more mentoring and coaching resources in the Commonwealth and to financial scholarship opportunities to assist at-risk students to complete high school, transition to post-secondary education, and persist once there. In identifying access efforts, we have looked to further existing programs with state and community partners and are establishing an access advisory committee with board and non-board members to assist in these efforts. So what will the expanded program look like moving forward? This puzzle pieces coming together gives you an idea or a preview. At its just concluded June meeting, the Virginia 529 Board approved moving forward with several new initiatives and partnerships. We're working closely with SHEV, with the community college system, with the Community College Foundation, communities and schools, and others to increase the number of mentors and coaches in the high schools and community colleges across Virginia. There'll be a particular focus on schools with high financial need, as well as high percentages of students of color, first-generation students, schools within the rural Virginia horseshoe, always keeping that focus on equity and inclusion, which is called out in the Virginia Plan. As these partners and programs were just approved, we're in the process now of formalizing our memoranda of understanding with our state partners to address the metrics and reporting required to ensure that program goals are achieved: access, affordability, attainment. The Virginia 529 team is excited about the potential to assist students who, by virtue of low household income or geography or race or ethnicity, have not had access to educational opportunities in Virginia, and to help provide a vision of possibilities for the future. Finally, let me shift gears again and take my remaining few minutes to provide a brief update on our latest mandate, developing and implementing a state-facilitated retirement program to provide a retirement savings opportunity for many of the almost half of Virginia workers who currently do not have an opportunity to save at work. That opportunity is important because what we know from the recently completed study done by Virginia 529 in 2020, and this is true across the country, is that almost 85% of people who are saving for retirement do so through a retirement opportunity provided at their place of employment. Basically, if you don't have it available there, most people just don't save for retirement. So this mandate that we've been given is similar in many ways to the education and disability savings mandates we already provide and have. They all relate to financial education, to financial awareness and well-being that come with a clear vision of what's possible. As our longtime vision statement puts it, to dream, to save, to achieve. I'm not going to recount today the work that was done in 2020 and 2021 with respect to private retirement programs. The detailed study completed by Virginia 529 and its partners including Pew Charitable Trusts and eConsult Solutions, with assistance from the Georgetown Center for Retirement Initiatives and the many states already providing retirement solutions in their states, as well as other resources, are available on our website. Suffice it to say, the goal of a state-facilitated retirement program is to provide a simple, inexpensive retirement savings option through the employment relationship that does not involve employer contributions, employer responsibility, or participation beyond assisting and onboarding their employees with payroll deduction. And this will afford many more Virginians a real opportunity to plan for their future, so when they retire, they may maintain their pre-retirement lifestyle and retire with dignity. We're at the very early stages of implementing this mandate, as it just went into effect last week. We envision a 2-year planning and implementation process. However, we have already posted an opening for a program director to be our main contact within the agency and to help with the development of this program. The board will consider the charter for a program advisory committee, which is a part of the statute that enabled this legislation, to assist in this work. That'll be comprised of board and non-board members, and we're looking for individuals with expertise in defined contribution retirement programs. We expect to have the board make appointments to that committee in August and September. In addition, this fall, we will begin the process of identifying and selecting a third-party program administrator for the retirement program. We anticipate that record keeping, customer service, and many of those activities will be done by the providers. There are several who are already doing this across the country. After that initial work, the process of developing participation and implementation policies, establishing an investment framework, and developing outreach and education opportunities, and these are critical for both employers and employees, will flow from that. The Virginia 529 team is excited about the future. We'll spend the next 2 years refining and reintroducing ourselves to Virginians with our expanded savings and investment missions as we assist Virginians with the financial planning and goals most important to them throughout their lives. We will continue to enhance and expand our existing programs. We won't forget about those as we build new programs and partnerships for the future. Unless there are questions from you, I will turn this over now to my colleague, Michael Wynn, who is our investment director, to cover investments and performance, specifically focusing on defined benefit 529 programs.
Thank you, Mary Ann. I would suggest we hold our questions. Michael, if you could give a quick overview of the investment strategy. We've heard your actuarial report already. That would be helpful.
Thank you.
Good morning, Chair, Commission members. My name is Michael Nguyen. I'm the Investment Director for Virginia 529. Pleased to be here in front of you. This is our last presentation a year ago on screen. You're all a better looking group in person than through the screens. Let me cut to the chase really quick, Mr. Chair, and just preface my comments up front by just stating that over the course of the last year, our investment committee and board have spent a considerable amount of time reviewing our governance process as it pertains to the way that we invest. The outcome of this includes updates to several key assumptions and policies which we believe will continue to drive investment performance, and most importantly, continue to protect the defined benefits program, as Mary just shared with you, and for future generations of savers while continuing to maintain the ongoing fiscal health. Let me just quickly move this through the several sets of slides with updates for you. This slide, Mr. Chair, Commission members, just simply illustrates the recent changes in the governance process at Virginia 529 as it pertains and relates to investment decisions. Prior to these changes, our investment committee was responsible for both policy and implementation decisions. Through a series of meetings and thoughtful discussions, the committee and board felt that their time was best suited to focusing on policies, but delegating the implementation of those policies to my team and our investment consultant. We believe that this will improve timely and efficient investment decisions while also allowing the board and committees to focus on policies and monitoring. You heard earlier from GRS and JLARC staff about the audit of our valuation report. I think it's just worth noting to the Commission that the valuation process occurs annually within Virginia 529 with our boards and committees, and then the JLARC and GRS audits these every 4 years. The outcome of this valuation process is a report that gives us a snapshot of the fiscal health of the defined benefit program. I want to stress 2 quick, simple points here, and by no means am I trying to state that the technical work involved here is simple, But I think something to remember is that this valuation report is a snapshot in time, which first and foremost. And then the second point is that it's reflective of ongoing and long-term moving assumptions. The analogy I'll use here really quickly, Mr. Chair, Commission members, is something akin to getting your car inspected every year. The auto shop will tell you how it's running today, but how it will be running a year or several years out from now largely depends on the maintenance routines, how you drive it, and the road conditions that you drive on. So these assumptions, I would remind you, are just that. They're assumptions of future conditions, and that the inspection of the car, it renders a point-in-time view of the mechanical conditions of that car today. Let me cover two major policy assumptions here that are critical to the input of the valuation report. The first is the long-term investment return assumptions, which is essentially a way of saying how well can we project market returns over 20 years. The second assumption is what's going to be the ongoing cost of tuition inflation. These policy decisions include the modeling work of our consultants and actuarial consultants, resulting in a funded status, which gives you a sense of the fiscal health of the program. You heard earlier that our funded status as of the end of the last fiscal year was almost 160%, which tells us that as of that fiscal year end date, we were more than capable of meeting our future payouts to account holders. In short, the defined benefit programs are in great financial health. However, I will just make the caveat, as I mentioned earlier, that this is an investment return assumptions. While the investment return assumptions continue to be lowered, the cost of tuition inflation continues, we think, will rise, which has historically been the case. So on this chart, what we're trying to reflect really simply is that while investment returns are going lower, potentially you have the cost of tuition inflation going the other way, which is higher. So those are two caveats that we are trying to work with through our valuation process. The other thing to note is that as we emerge from the events of the last year, tuition inflation coming into the calendar year or academic calendar year 2021 and 2022 will remain relatively flat, as Mary pointed out earlier. So our actuarial and audit committee, along with our board, will revisit the short and long-term tuition inflation assumptions this coming August. And we're fortunate to have input from SHEB, the universities and community colleges, along with board members, executive director of SHEB, and the president of John Tyler Community College, who serves on the board and will be able to provide some input to us as we plan for tuition inflation. And while tuition inflation is much harder to predict, we have better confidence in making investment return assumptions, which is reflected in our asset allocation. Asset allocation, I think you heard earlier from CIO Ron Schmidt, is what really drives investment returns for us. This is a busy slide, but what it's meant to convey is that we are simplifying our asset allocation approach to provide investment staff and our investment partners greater flexibility to execute investment decisions. Sorry, I'll come back to this. In 2019, which is the far left column, we adopted an update to our asset allocation policy. As you can see, it was somewhat prescriptive and rather granular. Earlier this year, with our investment committee and board, they supported a roll-up of these asset classes into a broader asset mix. So what you see on the second column, it's not a large departure from what we're doing currently, but the roll-up just allows flexibility in implementation of these investment policies. And Mr. Chair, I'll wrap up my comments here by just simply sharing with you some of the investment results that we've experienced this fiscal year as compared to the last year when we were in front of you. We were underperforming our stated benchmark in many of the same manner that CIO Ron Schmidt at VRS shared with you earlier, so I won't belabor that point of it. But when you fast forward to the end of this first calendar year or the end of March, we have outperformed our benchmark by almost 1.5%. While I'm no means competitive at all, I would just state that we outperformed VRS in the 1 year at the end of the first quarter by we generated a 29% return, which outperformed VRS. So it's a little bit of competition with CIO Ron Schmidt. But compared to the full year ago, that return was a negative 5%. So we're really pleased with the investment performance that we've been able to produce for the savings program. So, Mr. Chair, with that, I'll end my comments, and I'm sure Mary and I are happy to answer questions you may have.
Are there questions from the commission? Well, I would remind the commission that this is a annual report that we get from the Virginia 529 program, and its growth over time. I want to say to you that we have had a discussion over the several years we've been receiving these reports as to what kind of risk should we try to set aside, how much should we expect to fund a program beyond what its requirements are. And you can see that this program, on the one hand, can be called very healthy. On the other hand, it can be described as being excessive in terms of the amount of funds that it has. Now, I know all about the inflation, recession, and how all those things go. And rather than try to resolve that issue today, which the staff and the program has some differences, I've asked Hal if he could to draft up a little directive, if you will, to have the JLARC staff spend some more time on looking at this issue and come back to us at another time as to what our policy program ought to be going forward. So, yes, sir, Senator Sproul.
Thank you, Mr. Chairman. Mr. Chairman, I was curious when he was saying they were outperforming VRS by 29%. What's the reason for that?
Senator, that's a great question. The performance was in total 29%, not outperformance by 29%. A lot of that was driven by just our continued allocation towards public equity market. We had much of a similar view as VRS did on the value cyclical nature and cycle, which is now starting to kind of rear itself. The other component of our outperformance had to do with our lean more towards large growth equity style allocations, which did very well, as CIO Ron Schmidt pointed out earlier as well. And then the other component, real briefly, is that our fixed income portfolio is much more grounded for inflationary pressures, and that's what you're starting to see help drive our outperformance as well.
Okay, thank you.
Absolutely.
So Hal, if you could give us a view of how we might proceed in terms of further studying this.
Thank you, Mr. Chairman. And just to reiterate what you just said, currently there's $1.1 billion in surplus funds in this. Now, they need some of that surplus to just ensure the solvency and that they can pay their obligations. But our actuary believes that there's a substantial amount of money as part of that surplus that could be used for other more meaningful purposes, like providing financial aid to disadvantaged students is one example. So we think it would be worth doing a study over the next year of JLARC staff to take a look at the various issues involved and potentially using some of that surplus in different ways. So I've got a motion that I'd like to read. We'll put up on the screen for the commission's consideration. Got it up? The motion? Yeah. It's, you know what the motion is? I mean, yeah, we share it with you. You don't have it posted. I'll read it slowly then if we can't pull it up here. All right. We'll go in and read it. Maybe we'll get it up here in a second. In light of the Virginia 529 prepaid 529 program's actuarial funded ratio of 157% and its surplus of $1.1 billion, which is projected to be $3.8 billion by the end of fiscal year 44, JLARC staff are directed to review the extent to which prepaid 529 surplus funds can be used to support higher education access and affordability in Virginia. The review shall include, but not be limited to, whether the prepaid 529 program and the new tuition track portfolio program should be combined for actuarial purposes, the actuarial implications of using a portion of prepaid 529 surplus funds to support access and affordability, including an appropriate funded ratio to provide reasonable assurance that the prepaid 529 program and the tuition track portfolio will remain actuarial sound, legal or statutory restrictions on the use of prepaid 529 surplus funds, the amounts of net operating fee revenue historically allocated to the prepaid 529 program and their subsequent investment earnings, options for using additional prepaid 529 surplus funds to support higher education access and affordability in Virginia, and other relevant topics identified during the course of the review. It's a mouthful, but.
Okay, it's moved. Is there a second? Second. Okay, it's moved and second. The purpose, again, is not to be critical of the program, but rather to recognize the program as providing many benefits, and the potential for even further expansion may be there. we can't decide that sitting here today, but we can have a period of time, have staff take a look at that and see what the options might would be. So any discussion? Been moved and seconded. All those in favor say aye. Aye. Opposed, no. Thank you, sir. And now we will turn our attention to a brief update. I know you've been getting questions about Virginia Employment Commission. Staff will provide us an update for our study that's now underway.
Yes, Mr. Chairman, I'd like to introduce Lauren Excel, who's the project leader for our VEC review. Lauren will stand up now and provide you with a brief update. Lauren?
Okay.
Good morning, Mr. Chairman, members of the Commission. I'm Lauren Axel, the project leader for JLARC's ongoing review of the VEC. We know you're continuing to hear from your constituents about the difficulties they're having filing unemployment insurance claims. We wanted to give you the opportunity to ask any questions that you have this morning of our ongoing review of the VEC, and we wanted to highlight a few issues that we thought you should be aware of before we meet with you again in September.
Yes, sir. Senator Perot.
When will it be fixed?
That's a good question,
Bottom
Senator.
line. Let's get to the bottom line here.
I've been called everything but a child ago. I got 2 reports of money against me. People cussing me out and say, it's your responsibility. You should file them. I said, I can't do that. So when is it going to be fixed? That's all I want to know.
Okay. And this update's intended to say, in terms of JLARC study, when that might come about. So it's an update for the time being. Thank you.
Before we get into any substantive topics this morning, I did want to take a minute to explain our plan for briefing the Commission on our findings, and most importantly, our recommendations over the next several months. In September, we will provide you with an interim report that covers the most time-sensitive areas of our review. This report will be a PowerPoint presentation, not a written report, and will include recommendations for steps to be taken in the near term. In November, we will issue our detailed final report. This will include a summary of actions that have been taken to implement the recommendations that we issue in September. And the November report will also include our findings and recommendations related to VEC's management of the UI Trust Fund, UI benefit levels, employer taxes, and VEC's workforce services. Mr. Chairman, I'll pause there to see if there are any questions about this reporting plan.
Any questions? Hearing none, we'll go forward.
Actually, before I leave that slide, Mr. Chairman, I did want to point out that on this study, JLARC staff have deviated from our usual practice of waiting until the end of a study to recommend that an agency take certain actions to remedy operational shortcomings. We do not usually recommend anything to agencies while a study is ongoing. However, during this study, we have recommended to VEC leaders that they take specific actions where we have felt confident that the actions will lead to near-term improvements. I'll describe that more a bit in a minute, but did want to make the Commission aware that we have been engaging in more real-time oversight on this study than we typically would. And now for a brief update. The first topic I want to cover is the performance of VEC's call center. It will come as no surprise that VEC's call center performance is not meeting industry benchmarks for timeliness. For example, in May, VEC call centers only answered a small minority of the incoming calls. At our May Commission meeting, Delegate Austin asked us to look into the model that VDH used for operating its call center to respond to the public's inquiries about COVID-19 and vaccine availability. We did look into that model, and it appears to have been pretty successful. We recommended to VEC leadership that they consider adopting a similar model as soon as possible, and to expand their call center capacity as part of that model. VEC is working to finalize a contract with the same contractor responsible for operating VDH's call center. My understanding is that this will give VEC several hundred new call center operators. This is important to address the call center's ability to respond to current call volume, which is likely to remain high over the next several months and potentially into 2022. The second topic to update you on is VEC's claims processing. As you know, there was a backlog of about 92,000 claims that were going through VEC's adjudication process. Adjudicated claims aren't straightforward and do require further review by VEC to determine the person's eligibility and amount of UI benefit. VEC reports reducing that backlog to around 40,000 claims over the past 2 months, but concern has been raised that additional adjudication issues have been added to their backlog during this time. While working on these issues quickly is a priority given the public's need, we did want to alert the members to the possibility that VEC's efforts to streamline the claims process to reduce that backlog could have some negative downstream effects for both VEC's workload and for claimants if accuracy is being sacrificed for the sake of expediency. In terms of the additional staff who have been brought on to work these claims, it's worth noting that there has been turnover among some of those staff, so we are working to determine what the actual increase in staff has been. This is something we will have more certainty on in the coming weeks, but the narrative that casts VEC's performance in this area as entirely positive may not be presenting the full picture to legislators. And finally, the third topic of this that I wanted to cover this morning is the status of the new UI system. The governor has directed VEC to implement the new system by October 1st. My team has previewed the system, and we do believe that it has the potential to offer a significantly improved claimant experience. We are actively monitoring the progress of implementation, as well as the steps that VEC and the contractor are taking to minimize risks. VEC and the contractor have acknowledged that there are several issues that create risks for the success of the October 1st go-live date. These include the availability of VEC staff with the necessary programming expertise to convert the data from the old system to the new system. Another risk is that some data will not convert accurately, which could impact VEC's claim records. As far as planned functionalities for the new system, VEC and the contractor have estimated that about 2/3 will be completed by October 1st. The remainder will be operationalized after the first phase of implementation. And the 2/3 that are planned for completion on October 1st appear to be most, but not all, of what experts deem important functions for modernized UI systems. Another thing we wanted to make you aware of is that there could be a blackout period around the time the new system goes live and the old system is taken down. We understand there are a few different options for how to manage new claims during this blackout period, but regardless of how it's handled, it will create a new challenge for the public that we think the General Assembly members should be aware of. Finally, we do have some concerns that even if VEC and the contractor are able to turn on the new system by October 1st, there may be user problems. There were several problems with the phase 2 of this three-phase UI modernization project that remain unresolved to this day. Further contributing to our concern is the fact that there has been a fairly limited focus on end-user testing and VEC staff training to use the new system before the go-live date. I know that's a lot to absorb, Mr. Chairman. I'd be happy to answer any questions that you have to the extent that I can at this point in our study.
Mr. Chair.
Okay.
Mr. Chair.
Delegate Herring.
Yes. And just let me start at the first question that I have, which is the claims processing. And you mentioned turnover of staff. What time period are we talking about that you all have identified that there was a significant turnover?
So we've been looking really since the pandemic began, and it seems like some turnover has been ongoing, both with VEC staff who handle the adjudications, so that larger backlog, and with some of the contractors that have been brought in to handle those adjudications as well. I don't have the specific numbers broken down by date. VEC might have more specifics on that, but we have been following closely that turnover.
And Mr. Chair, just one other question. The blackout period that you mentioned is anticipated, and I imagine when new systems go up, there's always a blackout period, but is there any idea about how long that would be?
According to our discussions with the contractor and VEC staff, it sounds like they're shooting for a long weekend type period. I believe it might have been a Friday through perhaps a Monday, and we're going to be following that closely as well.
Other questions? Well, yes, sir. Senator Sproul. Okay. Hey, turn your mic.
I'm sorry. What I'm getting now, say they are calling us now, but they said to make sure things will be successful, they give us another number to call. That other number they calling, they're not getting the results from the other number they're calling. That's what happened. The second thing is that so I want to make sure that my friends on both sides, I'll get reelected, can put off the election so that this won't affect those who get run for office this year. Thank you so much. The job well done.
Other questions, comments?
Mr. Chairman?
Yes, sir. Secretary Pike.
Thank you, Mr. Chairman. Just add one question on, you referred to the call volume and the call center performance. I don't know that you had said sort of the stats changed since May, if the calls answered and received. Sometimes it feels like all 40,000 calls come from my district because they're coming back to me, and I'm sure everyone here feels the same way. And so can you speak to that in terms of the call center performance? I mean, sometimes just someone picking up a phone is like the first step to say, okay, there's a human being who understands my problem. That seems to be the first port of entry. Has that improved, or can you speak to the stats a little bit?
I don't have the historical data in front of me this morning, but from what I remember our team having received from VEC, I think the call center performance has kind of changed over time. Some of the numbers, I believe, look a little bit worse currently than they did during the peak of the pandemic, and that might be a factor of just more people calling in for questions now than perhaps they did early on as things have continued to go unaddressed. But as of right now, it looks like only a small portion of claims are being, or of calls are being responded to by VEC staff. It does seem like they've implemented a few new tools along the way from the beginning of the pandemic through now to try and help address some of those calls. They have enabled a callback feature that we've asked staff about, so people are not necessarily just sitting on the lines during the whole time. But we still do feel like the capacity could be increased, which is why we're encouraged to hear about the potential to bring on that contractor and additional staff.
Okay, well, thank you for that update. I thought it would be helpful for the commission to know that while we're underway with a study, we're also actively involved with VEC to try to correct these things as quickly as we can. The best case situation would be our reports saying that, well, I had a lot of problems, we got them solved, as opposed to waiting till we get a report and then working on the solution. So that work is actively underway, and so thank you for your report today.
Thank you, sir.
Al?
Mr. Chairman, that concludes our agenda for today. Our next meeting is Monday, September the 20th. In addition to VEC that day, we'll be presenting the findings from our review of VITA's organizational structure, staffing, and recruitment and retention. Thanks very much for your attention today.
Okay. Do we have a motion then that we adjourn? And seconded. All in favor say aye. We are adjourned. Thank you.